HedgeNordic, your single access point to the Nordic hedge fund industry. CTA Multi-Manager Webpanel, hosted by Cameron Galici, publisher at HedgeNordic. HedgeNordic is delighted to host this panel of 4 CTA multi-managers. By the nature of the game, these experts are among the most sophisticated and knowledgeable CTA investors in the world. In this session, we will be looking into how the managed futures space weathered the storm in the remarkable trading days in March during the COVID crisis, explain the dispersion among managers and contributing factors. We also hear what takeaways and learnings this period offers managers and investors alike, and offer an outlook for managed futures. We are joined by Alexander Mende, Senior Investment Analyst at RPM in Stockholm, LGT's Head of Managed Futures in Zurich, Roger Hilty. From Dublin, we welcome Mick Swift, CEO at Abbey Capital, and from Chicago, Illinois, Chad Martinson, Co-CIO at Efficient Capital. It is the first time these 4 managers appear on a panel together in any shape or form, so buckle up for some unique insights into managed futures.
Gentlemen, very warm welcome. We're looking back at some extraordinary times now with COVID-19 having us under tight bondage. It affected us, of course, as individuals, as families, as businesses. And that's also the first thing I would like to look at is how did the situation around COVID affect you and your companies, everything from possible lockdowns, shutdowns, market activities, and how did you cope with that as companies? And Chad, maybe I'll start with you on that one.
The lockdown as it went here in the States was pretty seamless. Everybody was set up to fully work from home. So as far as infrastructure and the actual processing of the daily information and managing the portfolios, there was no problems. It was unique for me personally because I ended up testing positive for COVID-19 in March. And I was on a very strict lockdown for 14 days until I got clearance from the Illinois Health Department to re-enter society safely. Fortunately for me, the impact to my health was very minor. I had a very mild case, some unique things that I never had before. Some of you've heard in the media that some people lose their taste and smell. For me, that was the case, and it was very acute. I couldn't tell the difference between a glass of milk and a glass of water. It was completely gone. So that was the most acute symptom I had, fever, slight cough, more like a cold symptoms than anything else. But the unique thing personally for me is I couldn't leave the house. I couldn't get to the office if I needed to. So fortunately, everything was set up and it was an easy transition to remain in my home for those 14 days very strictly.
And Alexander, how did it go for you in Sweden in RPM? Obviously, Sweden did not have those formal lockdowns, but how did you?
We are, our government chose a slightly different path, but I guess in most of the media that's understates what companies and people are doing here. So there were a lot of voluntary precautious measures. For example, we are advised not to use any public transport. So everybody's been really healthy, walking to work or taking the bike. So that's something new. We're working in shifts to keep the operations going. So if anybody is infected, that we don't infect each other. So it's basically at between 11 and 1 o'clock, everyone says hi, and then one part leaves, the other comes in. A lot of hand sanitizers here. Me personally, I was at the Carnival in Germany, and our CEO said, "Okay, when you're coming back, please stay home for 2 weeks just to be on the safe side." And I agree with Chad here. The thing that has changed is basically these one-on-one meetings with people in the same room. So we have had no physical client or manager meetings since then, but everything has moved over to Zoom or MS Teams. And the operation itself, we are used to work from home here at RPM. Everything is cloud-based and VPN access and everything. So, if you have a plumber coming over, you can work from home and take care of them as well.
Okay, but also everything worked seamless. Was all your brokers and all the counterparties obviously?
I have not heard or experienced any issues. All the numbers calculated as usual. All the managers, nobody has reported any issues. So
you guys have quite a helicopter view of many different managers you're investing in. Did you experience that any individual managers, either by geographical spread or something, had any issues? Maybe Mick?
I suppose following on from what the guys have said, you know, it was a very smooth transition, and that followed through to in terms of working with the managers as well. You know, we saw a little bit of noise in March around the short selling bans, but generally speaking, all the managers themselves were you know, moving to remote locations and operating fine. And then with the brokers, the prime brokers, the clearing brokers, the same as well. So we actually found the transition relatively easy, as it sounds like everybody else did as well. And I think it sounds like we were all well set up for that, but the managers themselves, you know, I suppose in many ways are used to doing this as well. And it just was a more extended version of it. So no, overall, you know, I'm sure like everybody else, our contacts with managers increased quite a lot. You know, having managed accounts obviously helped significantly in that sense, but just a lot of the qualitative type contacts and how people are managing and coping with that and dealing with whether they had COVID outbreaks themselves or not. But the remote environment certainly didn't cause any issues for us over that period.
Okay. And Roger, how did you see that period for yourself, but also in contact with your managers?
Very similar as Mick said. We also have a managed account platform, and with daily position transparency, obviously that helped a lot. It was also another proof, like after 2008, that showed how important the operational infrastructure is for trading and execution. So from a manager perspective, we had the lockdown transition smooth, no exceptions, no interruptions. There was one situation, we have an investment with trend following CTA also focusing on alternative or exotic markets, so to speak. And that manager was fine as well, like any other CTA, able to transact. Although if you look at even some of the most deep and liquid markets like treasuries, you had bid offer spreads 8 times as usual. But this particular manager focusing on exotic markets said there were some issues with some brokers in OTC products. I think brokers, future commission merchant FCMs in traditional, I would say, trend following products, no issue at all. But further on the OTC markets or emerging market interest rate swaps, every broker and like any financial institution, including ourselves, well tested with backup disaster recovery sites. So if you need to transition your entire team to another place, well tested works. But now this, with the pandemic, people were dispersed and everybody needs to go individually to a home office setup. So that seemed to be affected some of the brokers. Liquidity was worse, and what some of these managers did in, let's say, less liquid markets, reduced position sizes, traded less in terms of average trading volume. But that situation also normalized then thereafter, towards the end of March, relatively quickly, when all these brokers got ready and also home office setup worked very smooth for them. Okay.
You are not in a unique position, but of course you are not just investors in CTA. That's one thing that combines you. Is you invest into other managers, but you are of course also asset managers who are in the market trying to attract investments from investors. Did you have any communications from investor side in the sense of they were, you know, just asking, concerned about how you were handling things, because obviously everything they did on you when it comes to operational due diligence and everything went out the window. Any concerns there?
Obviously, as Mick mentioned before, the home office setup, what we experienced is that the frequency and the intensity, I think, moved a lot. We have a research team of 17 analysts globally, with main offices for research in New York, Hong Kong, and Switzerland. And the team feedback is that it's actually more intense in terms of the diligence what we can accomplish right now, because it's even easier to access managers right now, to get them on the phone. And on the contrary, as you say, attracting also capital from investors. We have also had more calls and discussions with prospects or investors. So from that perspective, we are much closer, interesting enough, with this pandemic to the managers in terms of more frequent conversations, and also with our clients. Because traveling also, as we know, is not only cost intense, but it's also time intense. So we can save all of that, and it's actually quite efficient, and we all have good infrastructure. So everything has been running well. Investment committee runs uninterrupted, and we've continued to make investments as usual.
In the initial shock in March, I suppose a lot of investors were looking at other strategies in the sense where had other fires to worry about. So to some extent, the strategies that we see in managed futures were doing what people would generally expect them to do, and to some extent the liquidity profile helping as well. So I suppose what we found a little bit was people were busy dealing with the sudden impact of the moves we saw, and that probably was a little bit of a distraction over those early months, and more of a return to normal, I think, as Roger has just said, as time has gone by. But that's normal for these type of situations, as we know, when we see a spike in volatility. There are lots of things going off at different times.
That's a good keyword. Maybe turning to Chad. Chad, let's recap. I mean, what was extraordinary also for people looking at financial markets was everything that started happening, and now we can start arguing when it happened in early February maybe, but when we had this huge volatility spikes and these swings of S&P moving up and down 10% a day, how were CTAs in general positioned going into this period, and how did portfolios react and change and shift through those weeks of, say, late February, early March, going into March?
That was really quite stunning. Everybody kind of looks at equity markets, but that's obviously we all run diversified portfolios. That was only a small piece of the equation. Coming into February, really February 19th was using the S&P as a proxy for risky assets. That was the all-time high put in February 19th before equities started selling off. Obviously, given the run in equity markets, managers were long equities. However, if you look at the portfolio across multiple different trading strategies and stress test those portfolios against previous crisis type events, they were actually positioned quite defensively with long bond exposure, significant long bond exposure, long precious metals, generally not big positions, if anything short energies. But a big position was a long US dollar position. The US dollar had rallied really sharply into that February 19th timeframe when the collapse began. So when you stress test, you know, the exposure that was in the portfolio against previous market moves, be it Brexit, be it, you know, what happened during the financial crisis, it was actually quite defensive. However, the big swing came with currencies. A lot of people forget during the first 2 weeks of the crisis, from February 19th through the first 6 trading days of March, the US dollar took it on the chin, really fell sharply during that period, where during past crises it had rallied. That ended up taking most managers to significantly reduce that dollar exposure. And then beginning on the 7th trading day of March, really through the end of March or close to the end of March to the equity lows on March 23rd, the dollar rallied sharply. It rallied more than 8% intra-month from that low. That had that been the move for the month, that would have been the largest monthly move since the end of the Gulf War, when Iraq signed a peace accord. So, you know, really some interesting things that happened. Unfortunately, obviously, managers lost money in equities. They also lost money from that long US dollar exposure at the beginning of the crisis. But the one thing that we saw across the board, without exception, managers were very quick to reduce exposure. Obviously, with the spike in volatility, being able to see how much position was taken off very quickly was quite stunning. You went from, in all markets, not just equities, interest rates, currencies, commodities. You look at a position or an exposure graph and everything collapses pretty quickly. So the spike in volatility was really incorporated into systematic trading, discretionary trading very quickly, and they were very quick to remove or reduce exposure to compensate for the increasing volatility.
Yeah, I want to add that not only the breakdown, but for the long dollar, there was another relationship that broke down in the second week of March, and that was the typical long bond being a protection against equity sell-off. In the second week after the famous Trump speech, even yields shot up as managers or as investors were going into cash and away from bonds, and that hurt also a lot of managers that typically have this position on.
Now, the CTA space is, of course, not a homogeneous space. It is, in fact, quite heterogeneous. And I'm pretty sure all this moving around in markets, or actually not pretty sure, we saw it, led to an unusually high dispersion among different managers. Does anybody want to pick up the ball on how this dispersion came from and who were winners and who were losers and what factors contributed to that?
Sure, I'll throw out first or take first swing at that. So the one thing that you saw across the board, there were very few managers that made money in equities. The vast majority of managers lost money in equities. They came into February 19th long, they reduced that exposure, They got short eventually, but it wasn't generally quick enough to make a lot of money in equities. The big component of performance dispersion was really how you fared elsewhere, be it in commodities, currencies, or interest rates. And that's where we saw tremendous dispersion among managers. Managers that were highly reactive to that early dollar move tended to underperform because they didn't profit once the US dollar started to rally, depending on your exposure in interest rates and in particular commodities. That was really a big swing component. If you performed quite well, which many managers did in commodities, you were able to offset those equity losses and generate some positive return in March. But lots of dispersion, but really driven by the other sectors. The equity piece was more about how much you lost or how little you lost. If you were able to get out of the way quickly and not lose a lot in equities, you tended to outperform as well. But generally speaking, most managers lost in equities and made money elsewhere. And
maybe just to add to that, you know, while the dispersion levels were quite high, and Chad mentioned earlier on, just the volatility of the underlying markets were at levels we hadn't seen for some time or forever. What we did see was, you know, the more faster performing trend followers were more the first responders and did better. And in particular, we saw, for example, some of the shorter term managers perform better in this environment. And that's a group that, you know, over the last couple of years have found it tough at certain times. So we saw a little bit more positive attribution coming there, which certainly helped given the very swift nature of the moves we saw in markets. So that helped a little bit, but nonetheless, the dispersion levels were very, very high across the sector, which is obviously can be a challenge for investors when they look at the space too.
We saw that as well. Trend following did exceptional, I think, pleased everyone. January, February, March, positive numbers. As Mick said, the faster ones, with faster signals and speed, were much more adaptive, did exceptionally well. I would say on the quantitative side, as Alexander mentioned before, fundamental relationship, obviously, with this speed and magnitude of the move. I mean, this has been unprecedented in terms of the sell-off of the speed in stock markets, with circuit breakers hit at US exchanges multiple times. So breakdown of certain fundamental relationships, quantitative macro, systematic macro. Some managers did struggle, especially the ones which are also slower and have a longer trading speed on average. What I would also add is that we observed also something similar like in 2008, that there was some discretionary intervention by some of these systematic managers, whether it's on the trend following side, quant macro, even short-term trading. As Mick said, I mean, some of these moves have been beyond, and the models weren't fast enough to adapt. We have seen 4 of our trend following CTAs reducing the ex-ante portfolio wall, took risk down across the board, not sector, not market specific, but they reduced risk. They were more conservative. similar as we observed this through managed accounts back in 2008. Quantitative macro similar, and then even one of our systematic short-term traders who has done well because of market liquidity reasons decided to actually go full in cash and stop trading for 4 trading days starting on the 23rd of March until the end of the month. Things normalized, everyone is back at full risk, but that's something similar, and we haven't seen it since 2008.
It's really hard to generalize. If you look at the Nelson report, I think if you look at the spread between monthly outcomes is between like 50% can it be between some managers for March. But if you want to generalize, you can see 4 things. First is that large established managers underperform the smaller, older or younger managers, but large players have underperformed in March. This, as Roger said, the slow-moving system also have underperformed the faster, the more reactive systems. And as Chad has said, the financial heavy managers underperformed the managers with more commodity focus. There was more protection to be found in commodity markets. But what we've also found is that once again, more complex approaches have also underperformed in these crises than more, let's say, I don't want to say simple, but let's say more robust, more pure systems. And that's something that's basically, that once again illustrates this trade-off for if you go with a complex system, then you have like a better performance, like in the long run, over the long term, with no crisis in there. But once the crisis hits, these pure systems really deliver, even though they have underperformed in calm times. Like for example, in trend following, you have ISM really strong performance, but they market themselves with pure trend following. Then you have Winton who do like 25% other or something. So it's and they underperform. So it's really, this simple systems seem to be better in crisis. That's our takeaway, at least.
Yeah, one other thing, one needs to look no further than the SocGen trend indicator, which is their simple system that they run to replicate trend. I think coming into February, it was in a 40 to 50% drawdown. But in March, it returned 16, 17%. So a simple system obviously had underperformed coming into the period, but then had a big explosive run up in March. And, you know, our friends at SocGen do a really good job showing how that indicator is positioned in different sectors and where it's making and losing money. And like other managers, lost money in equities, but it had explosive gains in commodities.
Did any of you make changes in this period to the portfolios? Like, did you drop managers or pick new ones up, or did managers move up their rankings on your radars because they got through this period better or worse than you had hoped or expected?
As all you other guys, we also have separately managed accounts, and we have daily liquidity and see what our managers do. So, and we try to be very active all of the time, not only during crisis, but this 4 to 5 weeks was really the most active I have seen RPM since I joined in 2005. And it's been all over the place. First of all, we started reducing risk in mid-February because we have our risk indicators told us it's time for a new sell-off because everyone is correlated and doing the same thing. So that's the first stuff that we do. We reduced risk and took away money from trend following from mid-February to mid-April. We had to close one manager because they breached their predefined drawdown and stop loss. So that was a what's it called? Artificial intelligence machine learning system that had never had the chance to train on data that we saw. So that was had to close that. And we also had some very strange position taking at times where we had to react and reduce managers that were responsible for those positions.
I would say we were on the other end of that spectrum. Obviously with the managed account platform and transparency in every single position, there were really no surprises in the portfolio. It was managers reacting and responding as we would have expected. Because managers were reducing exposure very quickly, we didn't feel the need to step in and take any money off the table. it was more about understanding what you should expect from managers and making sure that what you were seeing was in line with those expectations, and monitoring to make sure. Of course, if we had seen something that was significantly outside, we would have obviously stepped in and taken action. However, that wasn't the case for us.
So we've been dancing around the topic, but let's look at performance. So how did your programs or the CTA space perform as a whole throughout this period? And do you feel within line of expectations what you expect as investors, but also what investors may have expected from you guys?
I think if we look at it, we've all been through it. As I look around the panel, we've all been through lots of crises over our career together and separately. But every crisis is similar and every crisis is very different, and it's only when you sort of live through them, the rear view mirror tells us what it felt like. So I think, what was different about this was just the speed. And we've talked about it in terms of speed of response and the ability to respond and where the attribution came from. And, some of the newer systems not being able to, as Alex said, not being able to grab the data quick enough to understand. So I suppose we would see it as being sort of, as we sit at the half year, a year of 2 quarters, the first quarter, which was the sell-off and the response, and generally speaking, CTAs did okay in that environment. Whereas in the quarter 2, a bit more difficult given the rebound that we've seen and somewhat of a give back. So I think when investors look at it, I think certainly from our perspective, we would see that investors were, as I said earlier on, busy looking at other things, but were relatively comfortable that the underlying liquidity and performance was okay. Probably would have liked to done a bit better, I would say. But again, understanding, we have the challenge of education all the time is explaining of, given the intensity of the sell-off and the speed coming from a low volatility environment, which we've been very used to, how that affected the impact and the lack of follow through. So I think people see it like that. I think quarter 1 stands up quite well. Who would have seen at the end of quarter 1 what we've seen in quarter 2? They're very difficult to predict. And yet the consistency, as everybody has said, in a way of trading through that environment and dealing with it as it comes. I mean, what it highlights to me very clearly is just the strategy we all work in is one that acknowledges uncertainty, and the reality is we don't know what's coming next, and we best put our portfolios out there to deal with that reality in our own different ways. So I think, generally speaking, the feedback we've got has been okay. Maybe could have done better, but very much still in the game, and did provide some diversification. Certainly the dispersion amongst managers in our space did attract a lot of attention, I think. And that was down to really weighting in the financials versus commodities, as the guys have said. So that's how I would see it from, sort of the rear view mirror as we are here in July right now, coming up for air, as it were.
Yeah, I would echo that. Investors always would hope for more. We as an investor would have hoped that our trend followers were up 20 to 30% in the first quarter. Unfortunately, fortunately, however, whatever angle you want to take, the second quarter, managers were positioned for massive crisis across every market. Fortunately for humanity, we didn't have that. Unfortunately for the P&L, we didn't have that. So it's really an interesting position where, on one hand, you're hoping for, from a P&L perspective and delivering on your investment mandate, for a crisis to continue and the fallout to increase, at the same time hoping that it doesn't. So I think investors, as Mick said, education is a big part of what we do. Understanding that their exposure to CTAs and managed futures is not there for the 8 days in February 2018, not necessarily there for a few weeks of crisis, but for sustained periods like what we saw in 2008, or even, I alluded to this earlier, had markets, the fundamentals kind of held up as they were in the past, CTAs would have been done much better because of that long dollar position that didn't work out. So I think investors understand. We've been very focused on educating them, helping them understand what the opportunity set is. And had this crisis continued, which is really why you have exposure, they would have delivered on that mandate in a significant way.
This whole dispersion we had amongst CTA managers, is that the perfect argument to be investing in guys like you and multi-managers rather than trying to handpick big blue chip names?
Yeah, I think it's all about model risk diversification. We have also like programs internally. We run we have a systematic trading group at LGT. There's a Chinese wall between the multi-manager business and the direct team. Have been running it since 2009. We have a tail hedge strategy, which obviously worked exceptionally well over these crises. We have a news-based trading team, which covers news sentiment. This up and down in the market's been driven a lot by sentiment. Program is up 22%, but we rather blend it in with other strategies because you do not want to be too exposed to certain models. So also here, if you ask Cameron on trend following, we're on a diversified book of trend following CTAs because there is a certain dispersion. As Mick pointed out, the speed of trend following CTAs mattered a lot. How you got into the crisis, how quickly you were adapting. So I think it makes sense to have what all of us offer, a multi-manager portfolio to offer robust risk-adjusted performance, to have a certain model risk diversification, but you have to clever and complementary put it together to not have kind of over trading or to pay too many fees for similar strategies. But this model risk diversification is very important. Your point, lesson learned, we are adding on to our tail risk fund, Dynamic Protection, which runs internally. It's future space, we can monetize. It's something, a lesson learned, if you see overexposure of trends in stocks, index futures, we can add that on. It helps, it delivers positive convexity. News-based trading is also hard to get on an isolated basis, but it complements well other trend following exposure or quantitative macro. I think there are lessons learned. You want to be more probably also in alternative markets. We expand existing accounts of trend following into more exotic markets because those are less prone to risk on, risk off behavior in the market. So I think for us, it's important to further expand and innovate around techniques. We have heard complex systems, but I think there's also innovative systems which could add to what all of us have been doing for the last 15, 20 years. Additional markets, I think, clearly helps just to also access additional sources of performance. But to blend it in a multi-manager portfolio makes sense because if you look at heat maps which go around in industry, there is always one trend following manager standing out on the top in one calendar year, and it might be at the bottom three in the next year. So just to pick and choose one, it probably doesn't deliver the best risk-adjusted performance over time.
Would any of you, of the other of you, take away any major learnings or findings from this period, in be it the way you're set up, your systems, your communications, the way your portfolios are put together? Is there any major learnings and takeaways from this period?
A couple of things, maybe just, I suppose, for us all, we've all been used to been out meeting our clients and our managers over the years, and that's, I think Roger mentioned earlier on, or sorry, Chad mentioned, sorry, was, been on the road, and I suppose we're all impacted by that and the uncertainty around that going forward, and the getting our messages across to our clients and engaging with our managers. That's, there are new challenges around that, how we communicate with our clients, and it's always, I think we all agree, it's a complex enough concept at times to get across, especially things like dispersion or the underlying drivers, etc. So I think that creates new challenges for us all, and we'll all have to be a bit more proactive around our communication in the digital world, how we embrace that. I think that's a big factor. Due diligence, I think we've mentioned a couple of times, both operational and new manager due diligence. I think we all place a lot of store on the relationship. At the end of the day, human beings build the model, so that's an additional challenge in the way that the COVID environment plays out for us all. But I think one positive thing is, I think for all of us, is that I'm hearing from everybody is that yet again our strategy, our industry, functioned normally through a crisis. I think that's again testimony to what has all been around a long time, but equally I think that's worked extremely well, and that's always a source of assurance to clients as well, because often we're not exactly the most important strategy in people's books, sadly, but the reality is we did all collectively do that. So I think that's a positive.
At RPM, we have three major takeaways. The first one, as I said earlier, that more robust, faster system have a higher crisis protection potential than the slower, more complex systems. So we like our mix right now, but we're going to keep that in mind, and we're going to keep communicating that to our clients. Second takeaway, even though there was a huge dispersion across managers and strategies and sizes and everything, I think two strategies or sub-strategies in the future space stand out. One is the VIX volatility trading space, where there were some very interesting manager once again delivering protection, and also the systematic commodity, what you call it, relative value calendar spread trading space that has delivered once again, as during all those VIX events in 2018 and prior crisis. So that is, we are looking more at those managers. And the third takeaway is that our early warning system, based on the data that we have from our managers, from the position data and the managed accounts, that works quite well, and we should maybe listen even more often to it.
And let's have an outlook a little bit on the space. So how are CTAs currently positioned, not just from the actual portfolio positions, but how are they looking at markets in general? I mean, obviously we have a discrepancy between the health crisis, where at least some areas in the world we're still in the middle of it, and the market crisis, which we have seemed to overcome with reaching new highs. Our CTAs, our managers in general, looking ahead at contingency plans on how to be operating. We mentioned recovery sites before. Can we have a little bit of an outlook how the CTA space is expected to behave going forward?
I would say contingency plans, disaster recovery site, as you all mentioned, having access through managed accounts, that's fully intact in place. I think there will be no surprises also during the next dislocation. Lesson learned, and I think also how the macroeconomic environment unfolds, is that we have new measures. We have potential yield curve control, which in Japan has been introduced in 2016. The Western world is also thinking about it. People say it's probably not the time to be overexposed to government bonds. If markets are manipulated, anchored somewhere, money will flow. And I think what we have seen with this massive sharp and the speed of the sell-off and the subsequent rally, also driven by a lot of growth and technology companies, we believe that this divergence between markets and the underlying economy at some point will narrow, normalize. There will be trading opportunities. I think it's all about probably patience, keep a robust portfolio, hold on to a high conviction strategic asset allocation mix. There's enough macro uncertainty, potential pockets of volatility. We are now on the way to the upcoming US presidential election, which could lead to market turbulence, higher volatility, geopolitical risk. I think there's a lot of factors which can drive markets. And I think systematic strategies should be well prepared to take advantage from what we're going to see over the rest of 2020.
As far as positioning, CTAs are still defensive. However, the defensive nature isn't as significant as it was in April, at the very tail end of the crisis before the recovery. We've seen that play out recently. We had the 6% sell-off day early last month. CTAs were generally positive on that day. Even yesterday, I know Europe didn't necessarily see this, but the US market sold off sharply at the end of the day. CTAs were generally positive yesterday as well. So they're positioned for crisis, but the key difference between how they're positioned now and how they were positioned on February 19th. They're back into a slight long equity position, but it pales in comparison to the size of the equity exposure that was present in February. So an equity crisis, should it resume and manifest itself in equities, is not going to be nearly as painful from a P&L perspective in that particular sector. It's all about, once again, what happens in the other sectors and where there is opportunity, because managers are still long bonds. They still have, although mixed, they're still generally long the US dollar, long precious metals, short energy. So if the crisis were to resume and we saw the same kind of moves we saw in February and March, I believe performance would be much better than it was the first time around, just because of the environment we've transitioned from.
I think just to maybe a slightly different perspective on that would be that, if we go back to the start of the year and the last long number of years, we've been in a very low vol environment, which has been quite trying for us all at times. And, I think what investors have woken up to in the last 4 or 5 months is uncertainty again. And I think we're still digesting that globally, and the moves we've seen in Q2 have really sort of been a little bit of a get out of jail card in some sense. And the disconnect between what we see in stock markets and the real economy globally is somewhat of a puzzle that can go on for a long time, as we all know. So I think in reality that the concept of uncertainty is more prevalent, and maybe diversification becomes more important. But volatility is something that we all hoped we might see maybe a year ago, and we've seen quite a lot of it already. So, we're always slow to predict what might happen, but I think perhaps those factors may be more important going forward.
And do you have views of how the pandemic might affect the entire investment process, communication going forward? I mean, we did mention, of course, our industry, asset management, is a contact sport, so we like to be in front of investors, and we like to be. But apart from that, is there anything else you can see? Like, could the travel restrictions possibly lead to a more local bias, maybe? Like that, I don't know. Maybe you are more tend to look more to European managers than US managers, or vice versa.
Sweden, again, a little special role in Europe. Until last week, we were basically banned from traveling outside of Sweden if you don't want to be 2 weeks quarantined anywhere. So there have not been any personal meetings since the crisis. Everything's done online, and that's going smoothly. I would actually say, if you're not sitting in New York or let's say London or Chicago, the real, like the big financial centers, if you're sitting in Stockholm like we do, then the local bias is not really an alternative. There are not so many CTA managers here, even though there are a few. And we at RPM, we're looking at small managers anywhere that sit all over the globe, and then sometimes in weird places. So I think it's a good thing that we can do more due diligence. We can look, the location of managers doesn't really matter anymore. It doesn't matter where they sit when they set up their screen and show us their office and how they're trading. And that can save a lot of money and time, as I think Roger said earlier.
I think Alex is right. I mean, as the only one of the group living on an island at the moment, we are a little bit constrained as well. And but equally, this is a global business, and I think where we see value and where we all look for interesting managers and interesting people doing different things, we cast our nets pretty wide, and that's something we've always done. I don't think that's going to change, and I think our underlying structures and technology support that. The use of managed accounts, the liquidity we all have. I think that certainly provides a very important risk overlay for. And as Roger mentioned earlier on, newer sources of alpha, newer systems, alternative markets. Even though we've seen a little bit of underperformance from some of the more, the more systematic macro type managers, that doesn't mean they won't perform and learn from this environment. So I think all of those factors come together. Certainly due diligence, it is a relationship business, but I think, we see it as we've all invested hugely in those relationships over the years, and they don't disappear overnight, and they'll continue. And so I'd be optimistic in the sense of how we deal with this. Maybe communications with our clients will have to change somewhat, and I alluded to that earlier on in terms of, you know, more of a digital presence for us all and how we manage those things. But many of us are doing those things already. So, and equally, it's been a great time to educate. You know, educate what we do, how we do it, how we think. I think it's very valuable.
Yeah, some things have changed, certainly. Spoken a lot to the digital interactions, but some things remain very much the same. Understanding your portfolio, understanding the risks, understanding the opportunities, monitoring positions, seeing how managers respond. All of those key components are unchanged. And it's important to have the infrastructure, to have the managed account platforms, that we all have to be sure that you are getting, extracting from managers in the positions and risks that they're taking what you expect, so that your portfolio will respond as you would hope.
And how are investors behaving towards CTA? Do you sense that there's an increasing appetite now, maybe with awareness of risk, that there's maybe some crisis alpha being brought into portfolios, some tail hedging? Do you sense there's an increased appetite from investors slowly coming into the CTA space again?
I think we had seen good interest in the strategy sort of coming into the year and late last year, mainly from longer term investors in recent years who are tilting portfolios a bit more towards alternatives, certainly as equity markets had gone higher. So I think that's been something that's been there for some time. My own sense is normally in a sort of post-crisis type scenario, it takes a while for people to sort of gather their thoughts and put the diversification in place and learn the lessons, etc. I mean, in a way, the moves we've seen in quarter two maybe put that on hold a little bit for people. You know, that's the reality, because we are always dealing with investors' forward-looking perception of returns and where they'll come from. Right now, as we know, it's been very, very equity-centric and very stock-centric as well. So I think we have to wait and let the year pan out. To some extent, we're just coming out of phase one of COVID, you know, and now we're dealing with the more return to work type environment. And the same applies, you know, for all of us and our clients. The same applies to our clients as well. You know, they're facing the similar challenges of getting together, you know, having the communal meetings, getting their thoughts together and looking at the rebalancing of their portfolios and then thinking about how they position on a longer term basis. So I think it's playing out. Certainly the signs, I think, I'd be optimistic, but it's each day as it comes too.
Yeah, I would say similarly, the more things change, the more they stay the same. We have investors that surprise us, kind of coming out of the woodwork with renewed interest, which we always have surprises from an investor perspective. And then there are other investors that have no interest and remain with very little interest. So I think some of that has to do with there are bigger fish to fry, so to speak, in the portfolio, other strategies that didn't do or perform as advertised rather than the managed futures component. But, you know, should this crisis continue and manifest itself in markets, in follow the real economy, I think that is going to spur interest, but that's more of a long-term play.
If I may add to that, I think with any of these extraordinary market environments or moves, investors screen back what has worked. And I think what we saw, if you look and zoom in, especially into March 2020, tail protection, tail hedge, long volatility, and trend following CTAs delivered. I mean, apart from that, there's not many which really stand out from a sub-strategy perspective. So that's clearly piquing investors' interest. So for us, we have good demand for these tail hedge or dynamic protection strategies, with the ambition level there to be carry neutral. Investors also look for smart diversification, what we all offer in a multi-manager portfolio, smart diversification if you combine trend with core macro, short-term trading, as Mick said, and so forth. And I think what clearly institutional allocators think through is how much flight to quality or safety protection do I get from my long bond exposure or government bond exposure in the future, where implied yields are if you have potential yield curve control. So where does that smart diversification come from? And I think we heard it from colleagues on the panel before, there's a lot of education. I think it's great to have the access to people, clients, prospects, visual, speak to them more often, talk about this space, how you can actually bring some smart diversification to an investor portfolio to make the overall program more robust. And I think that's what's going to happen. And as Mick said, these things take time. So it's not coming from today to tomorrow. We have some very nice surprises, investors topping up, but typically those have been clients which have been with us for years, did understand the space well, know the ups and downs, are quite comfortable with CTAs. But I think diversification will matter, and some traditional assets, flight to quality assets, will probably just offer less of that going forward.
Well then, gentlemen, thanks for being good sports, and that we managed to get 4 CTA multi-managers together for the first time into one panel. Wishing you all the very best, a great summer, and stay safe.
HedgeNordic, your single access point to the Nordic hedge fund industry.